Okay, let's dive right into this explainer. We all hear those same financial buzzwords completely dominating our feeds, right? But today, our goal is to just cut straight through the noise and look under the hood of investment funds. We're going to break down the actual mechanics of where you can put your money, the real trade-offs you make, and how these vehicles execute their strategies.
Here is our roadmap for stepping up this ladder of complexity. We've got 1. What actually is a fund? 2. Index funds, the passive approach. 3. Mutual funds, active management. 4. Hedge funds, the high rollers. 5. ETFs, the flexible hybrid. And 6, which is right for you. Let's get started.
Section 1. What actually is a fund? Pooling resources. At the absolute core of every single fund is a really simple concept. Imagine you and your friends are throwing a massive birthday party. If just one person had to buy all the food, all the drinks, and hire the DJ, well, that's incredibly stressful and way too expensive. Instead, everyone chips in, right? You pool your budget. A financial fund works exactly the same way. A group of people pool their money together to buy a wide variety of assets. We're talking stocks, bonds, maybe real estate, while the fund itself handles all the heavy lifting.
Section 2. Index funds, the passive approach.
So you've probably heard finance creators tell you to, just throw your money in an index fund and forget about it. But why? Well, an index fund doesn't hire fancy, overpaid analysts to try and pick winning stocks. Instead, it literally just copies a list. Think of an index like a giant scoreboard or a sample group that represents a specific part of the market. The S&P 500, for example, tracks 500 of the biggest companies in the US. The Nasdaq focuses heavily on tech giants like Apple and Microsoft. And the Dow Jones, that tracks 30 massive industrial companies like Boeing and Coca-Cola. An index fund simply mirrors those scoreboards automatically. There's no guessing, no picking. It is an entirely passive system.
And the sheer power of this passive approach, it's all in the costs. Because you aren't paying the massive salary of some hotshot fund manager to pick your stocks, the fees are unbelievably low. You pay what's called an annual expense ratio, which for a lot of index funds is as low as 0.02%. Think about that. That means if you invest $1,000, you are paying just 20 cents a year for management. 20 cents!
But okay, there is a mechanical trade-off to this low-effort, low-cost system. You can't just buy or sell an index fund at, say, 11 a.m. and lock in that exact minute's price. Doesn't work like that. Index funds are priced exactly once per day, right after the market closes. This is called trading at the net asset value, or NAV. If you place your order before the typical 4 p.m. cutoff, your trade processes at whatever the value is at the very end of the day. You do lose that real-time control, but honestly, for long-term investors aiming to build wealth over decades, this daily delay doesn't really matter.
Moving up the ladder, Section 3. Mutual funds, active management.
So while passive management is basically a set-it-and-forget-it automated system copying a list, active management, which is the absolute hallmark of most mutual funds, is entirely different. Here you have a professional fund manager, or sometimes an entire team of analysts, actively buying and selling specific stocks and bonds. They aren't trying to just match the market scoreboard. No, their explicit goal is to beat the benchmark. They actually want to outsmart the market.
But, as you might guess, human brain power is expensive. An expense ratio for an actively managed mutual fund is typically around 1.5%, and honestly, it can sometimes be even higher. Think about the massive jump from the 20 cents we just talked about. You are paying significantly more for this active management. And here's the real kicker from our source material. Studies have shown that most actively managed funds actually do not consistently beat the market over the long term. You're paying a premium for an attempt to win, but it's definitely not a guarantee. That said, they are still super useful if you want exposure to very specific sectors or a particular manager's unique strategy.
Section 4. Hedge funds, the high rollers.
Now we're entering the VIP room. Hedge funds pool money just like the others, but they are private, highly exclusive, and strictly reserved for accredited individuals or institutions. Why so secretive? Well, because they chase absolute market-crushing returns using highly complex and really aggressive strategies. We're talking short selling to bet against stocks, heavy leverage, which is just borrowing money to multiply investments, and wildly complex derivatives. Now, these bold moves can absolutely lead to astronomical profits, but, and this is a big but, they can just as easily trigger devastating losses.
And oh boy, the fees absolutely match the exclusivity here.
Hedge funds operate on the famous 2 and 20 model. They take a 2% annual management fee right off the top, literally just for existing, but then they also take a massive 20% cut of any profits the fund actually makes. As you can imagine, this heavily incentivizes these managers to swing for the fences with those aggressive strategies we just outlined.
Let's bring it back down to earth. Section 5. ETFs, the flexible hybrid.
ETFs, or exchange-traded funds, are essentially the brilliant hybrid of the investing world. They take the broad, wonderful diversification of a traditional index or mutual fund, but they completely change the trading mechanics. Remember how index funds force you to wait until 4 p.m. for an end-of-day price? Well, ETFs trade on the stock exchange exactly like an individual stock. You can execute a buy or sell order instantly at any given point during the trading day. Best of all, because the vast majority of ETFs are passively managed, meaning they're just tracking an index like the S&P 500, they maintain those incredibly low fees we love. You're looking at expense ratios often hovering right between 0.03% and 0.75%. Plus, almost all modern brokerage platforms let you buy and sell ETFs with absolute zero commission fees. They truly combine the low cost of an index fund with the ultimate real-time control of a stock.
Section 6. Which is right for you? Your financial goals.
So let's actually bring this all together for your own portfolio. For the vast majority of everyday investors who are just looking to build wealth over the long haul, index funds and ETFs are generally the absolute go-to. They give you diversification, super low costs, and a lot of historical reliability. Mutual funds, well, they make sense if you really want targeted exposure to a niche sector and you just don't mind paying a slightly higher fee for it. Meanwhile, hedge funds remain the strict domain of the ultra-wealthy who can stomach immense volatility.
Ultimately, your investment journey comes down to your personal strategy and what lets you sleep at night. Thank you so much for joining me for this explainer. I'll see you next time. But before you log off and make your next portfolio move, ask yourself this one crucial question. Do you want to simply ride the market to long-term wealth, or do you actually have the risk tolerance to try and beat it?